After the sharp sell-off of the last couple of days, today felt a little bit more calm, but still, we had more selling. The bears won the day once again. This was the third straight down day for the S&P 500. The Nasdaq's actually been down 5 out of the last 6 days, but the good news is all of our major U.S. equity indices do remain above their rising 30-day moving averages for the time being. However, we have seen some posture shifts from bullish to bearish in a few of those indices, and we'll talk about that in tonight's video. We'll also talk about some of the outperforming versus underperforming sectors. Energy really stood out to the upside here today. Healthcare and real estate really kind of struggled to the downside. And then we'll get into our trade application example where I wanted to feature a stock that's fairly well known to dividend growth investors, but kind of flip it on its head and do a bearish trade on it because it's a little bit overvalued at these levels and very well may be a good setup for a short selling opportunity. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 23rd, 2022. First of all, if you're new, welcome aboard. Remember to go to YouTube, click subscribe on our channel, then go down below into the description area and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. Also, at the bottom of those emails, you'll find which stocks in the S&P 500 are giving you overbought or oversold cluster signals. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me. And we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, we've got our S&P 500 heat map pulled up here. And for the most part, my eye sees a lot of red. I was a little surprised when I pulled this up initially because the market itself was only down about 0.24% today. It was a relatively modest day compared to the sell-offs that we've experienced the last two sessions. I was joking with my students here yesterday that I might have jinxed us because some of you might recall in the video that I did last week, I think on Thursday, I said, boy, it's been almost a month since we've had a 1% down day on the S&P 500, and wouldn't you know, we not only had one down day of 1%, but we followed that with a 2% down day. So just like that, we've lopped off about 3% here. Today was a little bit more of a modest sell-off, but it does appear that the breadth was still quite bearish, regardless of the final outcome. As you can see, most of these squares ending up here in the red or maroon color. There is one area that stands out to my eye, and it probably does to you as well, and that is energy. As you can see down below here, energy looks very strong today. The only exception appears to be Coterra Energy, which was down 0.88%, but I'm pretty sure all the other energy stocks in the S&P 500 did close in the green. Let me right click and go into zoom in on energy here just to verify that, and you can see that's exactly the case. There's Occidental, of course, having the Warren Buffett news over the weekend that the regulators will allow Berkshire Hathaway to buy up to 50% of that publicly traded company. As of right now, there seems to be no intention of buying it 100% outright, but they very well might end up owning half of the company. And then your other players out there, major players like Exxon was up 4% today, Chevron was up 3%. We had some of our oil field services companies like Schlumberger was up 6%, Halliburton was up nearly 7% here today. There's Devon with a nice 3% move. Even some of the refining companies like Marathon Petroleum up 3%. So all in all, seems like where we did have some nice aggressively bullish activity today was within the energy patch. Of course, that's not exactly where you want to see the strength of the market. In most cases, that could very well lead to heightened input costs for the production of goods and services in the future, and therefore could crimp margins of other companies. So not a perfect way to find some strength in the market, but it was there nonetheless. And remember, that's been a key story throughout much of 2022. There haven't been a whole lot of places that have had strength for a longer period of time. And although energy did kind of fall out of bed there at the end of June into July, it does seem like it has some interest. It's knocking on the door once again of potentially participating in a big trend type of a move to the upside. In fact, we covered energy stocks in my trend trading class just Monday, where we looked at 3 different oil and gas companies, and they were all up pretty nicely here today. So we'll see if that can continue or if this is merely a head fake. Nonetheless, that's the only really consistent area on this heat map from a sector perspective. From an industry group perspective, I would also probably throw semiconductors in there for good measure. While semiconductors are only part of the technology sector, that is a very important industry group, and you can see most of those did close in the green today. It wasn't as consistent as energy because you did have some holdouts like Qualcomm and AMD, but you did have some nice green squares out of NVIDIA, Texas Instruments, AMAT, Lam Research, KLA, Enphase, etc. So that was another kind of runner-up in terms of a little bit of at least some moderate strength here today. Keep in mind, NVIDIA does have their earnings coming out a little bit later this week, so that could change on a dime, but for right now, there was at least some bullishness kind of pushing into that area. You did have a little bit of bullishness maybe in some of the industrials, but it wasn't all that consistent, kind of hit and miss. But there is a little bit more green kind of popping up down there with Caterpillar, John Deere, GE, Boeing, Raytheon, Lockheed, those ones finishing in the green. And then a little bit there in the kind of consumer discretionary area. Of course, all eyes on Tesla there with a 2% move to the upside. Amazon up just fractionally. And then some of the smaller players like Booking.com and Las Vegas Sands and Caesars and Nike, Ford, they all did close in the green today as well. But that's about as far as I can take it. For the most part, the rest of the squares were firmly in the red. Now, the worst performer, at least one of the worst performers, I think it was the worst performer in the S&P 500 today, was Twitter. And it was down about 7% today, somewhat out of the blue, as there was a bit of a whistleblower coming out talking about the company's security measures and bots and things like that. And I guess the idea there is that could give Elon Musk a little bit of firepower to kind of fight against this proposed takeover of the company that he once upon a time wanted to own, but then after the fact decided he probably doesn't want to own it at the price that he originally committed. So anyway, it's going to be an interesting saga to see how that resolves itself in coming months. But for today, it looks like that was a win for Elon and a loss there for Twitter, the company, and the shareholders did suffer as a result of that. Also notice that it's probably not a coincidence that Tesla's stock was up, right? There's some fear out there that if Elon is forced to purchase Twitter, the courts make him purchase it at the price that he originally stated, that he might very well need to tap into additional Tesla shares to sell in order to finance that deal. He's already done that to some extent, but there is some fear that you might see a little bit more of that down the line. So on days when Twitter is down a whole bunch, you might expect Tesla to be up, but the opposite could also be true there as well. So be on the lookout for that possibility. Otherwise, it was pretty consistently red across the board. I noticed healthcare was down pretty tremendously today. I see very few stocks, maybe just Cardinal Health, Moderna, a couple others in the green, but for the most part, look at all that red and healthcare down below there. So not a real good look there either. All right, let's go ahead and now take a closer view at what the specific numbers were from a breadth perspective back on the main part of the platform. And I've got the S&P 500 pulled up here in the index watch area of the Visualize Market Watch tab. And you can see that out of the S&P 500 today, 197 closed in the green. And so that was good for about, 39% or thereabouts of the index closing in the green, which actually is stronger than I would have guessed by looking at that heat map a moment ago. To my eye, it looked like there were a lot more red than that. But nonetheless, this could include a lot of companies that were smaller that you couldn't really see that well on the heat map because that is judging it by market cap. And some of the squares are awfully small that you can't really see them. And even if they closed in the green by 1 penny, that does get counted in this. So maybe there were a strange amount of those here today where you found just fractionally higher. So all in all, it wasn't a wipeout today the way that we've seen in the last couple of sessions. I guess we should be thankful for that, but it was another day that was owned by the bears more so than the bulls. So let's now see what that means from kind of a charting perspective and from a market forecast posture perspective. And for that, I'm going to come on over here to the charts area, and we're going to start with our 4 grid. For those of you that are premium market scholars that have access to the 50 plus customized charts that David and I use, this is chart 4B if you want to pull it up on your side of the coin while I'm giving the presentation. And as you can see here, the S&P 500 was down 0.22% today, so a relatively modest sell-off. Nonetheless, this is the 4th sell-off in the last 5 days, so all of a sudden there has been a bit more selling pressure. For the NASDAQ, it's even worse, as this is the 5th down day in the last 6 days for the NASDAQ. But one thing that catches my eye is, despite the what feels like a consistently bearish market over the past week, we still remain above those rising 30-day moving averages. And remember, just last week when I was giving this presentation, I was urging you to be on the lookout for that, saying that we were so high above the moving averages that a sell-off is inevitable. What the real question is what does it do when it sells off? And where does it effectively try to stabilize? And because we had gone so high above the moving averages, I threw out the theory that it is possible that we pull back to the moving average and then end up kind of stabilizing there to see if it wants to bounce higher from there. Obviously, if that happens, that would be a very bullish sign. On the other hand, if more and more selling pressure leads to a further domino effect of selling begets more selling, and we crash straight through those rising moving averages, then all bets are off, and we could very well be back into more bearish conditions where we're going to be heading back towards those lows of the summer once again. So we're at a pretty critical juncture right here, where we've had this really nice move off the lows for the last 2 months. We've had a 1 week give back, but we still remain above that rising moving average, which can be used as support as we move forward. The other area that I urged you to look out for last week was this area over here on the S&P 500. At the end of May and into the first week of June, we traveled sideways pretty much every day during that week. And once we broke out and through there, I said that at some point we would likely retest that. Obviously, you never know for certain, but generally speaking, markets don't get too out of hand. They need to kind of backfill and revert to the mean and all that kind of stuff. So once we broke through there, we started out with that big gap right there, and we kept on cruising. Some people might have said, okay, this is our moment. Let's go ahead and load the boat to the upside. More cautious folks, and hopefully a lot of you that watch these videos probably wouldn't have gotten too caught up in that, with the expectation that there would be a revisit to that level. And of course, that is what we've done here over the last 2 or 3 days. You can see that gap is now filled officially. And where we ended here today, if you kind of use my mouse and the crosshairs of my mouse and track your eyes to the left with that gray horizontal line, you can see that we are basically closed here today right at the midpoint of that week's worth of trading back in the first week of June. So we're still within that range where this could be a theoretical support level as well. What you don't want to see is for us to breach below the lows of right here and right here. And on the S&P 500, that would have been on June 1st and June 2nd, and the low there on the 1st was 40.73, and the low on the 2nd was 40.74. So both in approximately that same area. Right now we're at 41.28. So we've got another 50 points or so to consider that. But what is interesting about that level to my eye is how it is coincidentally lining up right here with the rising 30-day moving average, right? You have a little bit of a confluence of events taking place right there. And so this is a really important level for the bulls. If people think that, hey, that was the low that we set there, again, I remain somewhat cautious around that idea. I try to keep an open mind around it, but it just kind of feels to me like we needed to suffer more pain through either price and or time. Usually, if we are in more bearish market conditions, they don't just evaporate overnight. We got somewhat convinced that that is possible because of the very strange circumstances that happened in March of 2020. But I think we can all admit that that was a black swan event that was highly unpredictable, both the event itself and then the eventual outcome of that event. So that is not typical what we experienced in March of 2020. What is more typical is that we have to kind of earn our keep. And, there's a lot of belief out there that we still had more pain. Remember, the market was only down 20% basically at its lows for the S&P 500. NASDAQ was down 30%, so a little bit more pain there. But, I kind of feel like I am still hesitant towards this market. Now, you have to be careful there as well, because I think that's just my personality in general. I'm a little bit more cautious and paranoid around that sort of a thing. And a lot of times my paranoia doesn't really result in a whole lot of effective success. In other words, markets have been known to climb the wall of worry, and if I'm just one drop in an ocean of a whole bunch of worriers out there, the market has climbed those worriers many, many times throughout history. So I'm not here to say it can't happen again, but in general, we're in a little bit more of a precarious situation right now, with inflation raging as high as it is, and with interest rates, at multi-year highs, and with the VIX getting a little bit higher here recently. Russia, Ukraine hasn't settled down yet. There's a lot of things that investors are concerned about right now. So it's a market that is keeping us on our toes, that's for certain. So keep your eye on what happens here in the next few days. We are at a critical juncture. We'd sure like to keep this above 40.73 if we want to be bullish on these markets right now. Remember, we do have Jackson Hole coming up later on this week as well. A lot of people anticipating what they find out from the Federal Reserve there. And then, of course, more interest rate decisions will come later on in the fall, September. But this week, it's all about Jackson Hole. So keep your eyes peeled to any new information that you hear later on this week, I think on Friday, on that front. But for right now, had a little bit of a setback in this March higher that was started at the beginning of July, and now starting to call into question the resiliency of the bulls here. But I don't think all hope is lost quite yet. We still have this rising moving average that should act as some support if there is any notion of bullishness out there, and look for that to occur in the relatively short term, right? That could happen within just the next few days. So I'll be very curious to see how that shakes out. For right now, we remain with a strongly bullish posture on the S&P 500. You'll notice the background color is still dark green. You'll notice it is still dark green for Dow Jones as well. But notice where their green lines are right now. Remember, this background color is effectively set by what's happening with the green intermediate line on the market forecast technical indicator. And if you are in the upper reversal zone with that green line, it's an automatic strongly bullish posture. Regardless of whether the green line is traveling up or traveling down, as long as it's above 80, we give it kind of that leeway, that grace period there. But I'm pointing that out because you'll notice that we are awfully close to giving up that posture. Right now, the intermediate line on the S&P 500 is at 81 and falling. Remember, all it has to do is go down to 79.99, and you would be there with a weekly bearish posture. And that could happen as soon as tomorrow. If we have a big down day tomorrow, that could happen tomorrow. And the same thing goes there for the Dow Jones. It's basically the same situation where you're at basically 81. It's at technically 81.88, but right there in the same vicinity as what we saw on the S&P 500. So theoretically, both of those could go to a bearish posture as soon as tomorrow. The other two down below are already there. You'll notice that we now have a light pink background color on the NASDAQ composite. You'll notice that we also have it on the Russell 2000. So the NASDAQ was basically flat today. Russell 2000 technically was up 0.18%, but it wasn't enough to offset the heavy losses that occurred the last couple of days to basically push this green line below 80. It's at 78.56 right now and falling, and therefore considered weakly bearish. And with the NASDAQ, it's at 76.70 and falling, so same thing, weakly bearish from a posture perspective. Now keep in mind on those top two charts, the S&P 500 and the Dow Jones Industrial Average, technically you did get what's known as bullish intermediate confirmation signals on both of those charts here today. And in the past, especially in the last 2 months, those signals have worked out pretty well. We've pointed out a couple of them along the way. But before we get too excited about that notion, I will remind you of something that we try to do to, try to interpret whether the signals are better or worse. And in today's cases, those bullish intermediate confirmation signals are a little bit worse. So first off, what is a bullish intermediate confirmation signal? It is a buy the dip signal. So if you think about the two pieces of that puzzle, one of the pieces is you need to have a bullish intermediate posture. The intermediate line is that green line I referenced before. And that green line can be bullish in two different ways. It can be either bullish by simply being above 80, like is the case with both of these right now, or it could just simply be traveling higher between 20 and 80 in that kind of more white neutral zone like it was back here at the end of July. So either one of those two would result in a bullish intermediate posture. That then needs to be teamed up with a red or momentum line in the lower reversal zone. Now in that one, it has to be in the lower reversal zone. It can't just simply be traveling down between 80 and 20. So right now we have the green line strongly bullish on both the Dow and the S&P 500, and we have the red momentum line in the lower reversal zone on both of them as well, which is why we have that signal that exists there on both of them. But here's the downside of it. Unfortunately, the signals are not considered ideal because of two different things. The first thing is the red line is so extremely low that it gives you the impression that it could start pulling the entire market down further. And what we consider to be an extreme reading on the red line is anything below 5. And you can see both of these are below 5. For the S&P 500, it's at 2.79, and for the Dow Jones Industrial Average is at 4.28, as you can see there in those red labels. So both of those are at extreme red lines. Our preference would be to have the red lines below 20 but above 5. So maybe threading the needle a little bit there, but it's not all that uncommon. In this case, both of those are below 5, and so maybe a little bit of more concern there. In addition to that, while the blue near-term line isn't technically part of the bullish intermediate confirmation signal, you can use it to try to find more ideal setups. And what we've noticed over the years is that if the blue line is somewhere between 20 and 50, the setup for the buy the dip is a little bit better. And in this case, you can see that the blue near-term line is extremely low, at 4 on the S&P 500 and 5 on the Dow Jones Industrial Average. So obviously both of those well below 20 and in their own reversal zones. And it's kind of the same concept as the extreme reading on the red line, which is there is a really big pullback here. This isn't just a modest, buy the dip signal. This is one that is threatening the uptrend itself. So most people, if they're trying to determine whether they want to buy the dips, they're hoping that the bullish trend stays intact. But because the selling has been pretty aggressive here in the last 3 days, it's possible that the uptrend itself is now going to be in jeopardy. And remember, as soon as tomorrow, it very well could be, because tomorrow, if we're at 79 on the intermediate line on both of these, then all bets are off. That is basically nullifying any buy the dip signal there, because at that point, you're thinking that the intermediate posture is then weakly bearish. So this is not exactly a layup in this particular case. Is there a pullback where you could buy the dip? Absolutely. The question is now, has the pullback been too strong, and is it so strong that it's going to lead to an actual trend change from going from bullish back to bearish? And that could very well be in the cards. So let's keep our head on a swivel, as they say. We could have an interesting week in front of us. Now, to wrap it all up, be aware that all 4 of these charts remain above rising 30-day moving averages. So those moving averages are still painted green across the board. And for the S&P 500, as I mentioned before, it was down 0.22% today. Dow Jones was actually the biggest laggard today. It was down 0.47%, and NASDAQ was flat. Russell 2000 up 0.18%. So a pretty modest day, all things considered. Notice that the range labels are blue across the board on all four of these charts today. What that is signifying is that today's range was light compared to the average true range that we had been used to for these charts. In other words, a very modest day of trading from high to low. So it's kind of a quieter day, at least compared to the sell-offs that we've had the last couple of days. So not a whole lot to glean from that because it wasn't aggressively bullish or aggressively bearish today. But it's been enough persistently bearish in the last week where it is starting to threaten some of our postures on these charts. All right, let's go ahead and step away and take a look here at the internet briefly. I always like to get a chance to say thank you to those of you that help support these presentations that you do find for free out there on YouTube. A lot goes into producing these videos, and we want to make sure that our efforts are worthwhile there. So what we ask out of you is just simply help support us, and the easiest way for you to do that is just by clicking like for us there on Twitter. As I always say, as long as we're up and over 100 likes, I'm happy to do a full-length video. If we're under 100 likes, then I would plan on just doing a quick 15-minute video with no trade analysis at the end. So that way it gives you guys an opportunity to decide collectively, do you like the longer form videos with some more 12 grid charts and some extras like the trade applications, or do you just prefer that we get on with things and just a quick little recap of the session and then you get on with your day? So I'll let you guys decide collectively there, but I do want to say thank you to the 105 folks that did click like for me the last time around. Let's give some shout outs here, as I like to do. Thank you to Ron and Deborah and Brandon and Carlisle and Tammy and Lucius, Michael, Tom, HR, Dennis, Packer, Valentin. I'm not sure who that one is, a new one there. Michael, Paul, Cynthia, Roger, Gerald, Paul, Prickly Trader, Jerry, Galaxy Heroes, Edwin, William, Today's Trader, Vodacon, Adrian, Andres, Surendhar, Evan, Austin, William, GJ, Terry, Craig, David, Ken. Too many to go through, as always is the case, but I do like to at least recognize those of you that do take the 5 seconds out of your day. I know it takes an effort. It's not a big effort, so I think most of you realize it's worth your while to do, but you do have to take an effort, right? There's a lot of other people that just sit there and don't do anything after watching the video. So I want to thank those of you that are motivated to engage and interact there with us. So thank you very much. I appreciate that. Keep it up. Let's also talk about the sector selector here today. A reminder that this gets updated on the weekends, and so it is a couple of days stale at this point on a Tuesday evening, but it can still give us a general idea as to any sort of sector rotations we're noticing out there. And we did have some interesting movements this week. Sometimes we see very little movement, sometimes we see a bit more. This week was an interesting one because we have a new number one sector up at the top, and that's utilities. Now, utilities has been one of the most consistent, as you can see here. The way that you read this is the most recent ranking is off to the right. So in this case, it would have been August 19th, last Friday when I put this together, and utilities was number one. But the week before that, they were number 3. The week before that, they were number 2, et cetera, et cetera. The lowest they've been in 3 months is 4th place. And yet they had never been number 1 in those 3 months. So as you can see, nearly the entire 3 months, it was ranked either 2nd or 3rd. And that is very consistent for a full 3-month time period. The only times that it was not ranked number 2 or number 3 was when it happened to be number 4 on July 22nd, and it happens to be number 1 right here, right now. Otherwise, every other week in the last 3 months, utilities have been number 2 or number 3. So they've been consistently strong up at the top. Others have had a little bit more volatility, including the number 2 ranked energy. They have been all over the map. And energy obviously is much more of a volatile sector to begin with compared to something like utilities that have more monopolistic characteristics. I always say that, utilities is, if I were to have some fantasy football speak here. We've got our draft coming up here on Labor Day. I'm looking forward to that. Many of you probably do a little bit of fantasy football yourself, so you'll understand the terminology when I say it's got a high floor but a low ceiling. Utilities are heavily regulated. They are needed by society, and therefore they're almost always going to earn a basic level of profits. But because they can't set their own rates, the regulators need to do that for them. Regulators wouldn't allow them to increase electricity rates by double, as an example, because it would price out a big portion of the market of lower income families and different things like that. So they kind of have to play hand in hand with regulators there. So they can't make gobs of money to the upside on earnings, but they have a built-in floor in terms of earnings that they are likely to make on the downside. So it's a more consistent experience when you're an investor in utility companies. Energy is not that way. They are all over the place because energy is really dictated by what's happening to the price of a barrel of oil. And the managers of the energy companies like Chevron and Exxon and Conoco and Occidental and all those, they can't control the price of oil. And so they are subject to the whims of the global commodity markets. And when commodity markets are strong from a pricing perspective, then profits are more likely to be strong for those oil companies. But the opposite is also true. So you tend to find that the folks that trade those securities are going to have a lot more whipsaws, a lot more head fakes, back and forth they go. And so energy happens to be on one of those upswings right now. We'll see how long it lasts. As you can see, the last time they were ranked number 2, they fell sharply the very next week. This time around, it doesn't feel like it's going to be that way to me, because as we've moved forward here into this week, we've actually seen some pretty good strength out of the energy stocks, including today. So I think that they're going to have a chance to stay up there at that number 1 or number 2 position as I rescore this upcoming weekend, at least given the information I have right now. You will notice that technology fell out of the top slot week over week. And one thing that I pointed out to my class on Monday that just happens to catch my eye, because a lot of you are looking for patterns as well. One thing that's kind of interesting is that you'll see that back here on May 27th, energy was at the top, and it was on the top for 4 weeks. That brown peg up there at the top for 4 weeks in a row. Well, that then gave way to consumer staples in the pink being at the top for 4 weeks in a row. That then gave way to technology in the green being at the top for 4 weeks in a row, and now we have utilities up there. So who knows? Maybe utilities stay up at the top for 3 more weeks. But that's kind of interesting to me. But usually, technology is not going to move around extremely aggressively, not because they're not all that volatile from a business model perspective, but more to the point because they have a lot of components and there's a lot of variability within the technology sector. Remember, energy is highly correlated to one another regardless of the industry group. Technology doesn't have to be. It still is a fair amount, but software can be completely different than hardware, which can be completely different than IT services, which can be completely different than electrical components, and so on and so forth. So you don't really see huge drop-offs like that all that often, but this week happened to be one of those weeks. So maybe that's a little bit of a warning sign there as technology is starting to loosen its grip on its outperformance here all of the sudden. All right, let's go ahead and now pop back on over to the main part of the platform and do some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. As this pops up here, just a friendly reminder that if the background color is pink, it means that they have a bearish intermediate posture according to the market forecast technical indicator, and if the background colors are green, it means that the postures are bullish. So as we're looking at this here, you can see that we have a few more pink charts on the board than what we've been used to in recent weeks. It seems like we've had more green than pink in recent weeks, but today it's kind of the reversal of that, and I guess that makes sense since the last time I was with you. We've had a pretty sharp sell-off in financial assets across the board, and remember, that's not just stocks. A lot of times we kind of fixate our attention on stocks here, and I'm guilty as charged there because I'm much more interested in stocks than bonds and other asset classes personally. But it is interesting to me that it wasn't just stocks that sold off in the last few days. Bonds also got hammered in the last few days. And the reason behind that is probably the same to a large degree, and it's surging interest rates. you can see down here in the lower right-hand corner that the TNX, the 10-year U.S. Treasury yield, is back above 3%. And it wasn't so long ago that we were closer to 2.5% at the lows back here at the beginning of August. So they've rallied pretty strongly, 50 basis points in just a couple of weeks here. And so that's starting to be a little bit of a concern for the financial marketplace out there. Remember, tech stocks tend to underperform when interest rates are rising because they're oftentimes viewed as long duration assets. And so with tech stocks being the most influential sector on the S&P 500 because it is market cap weighted, and Apple and Microsoft are the most important companies because they're the largest companies. So no surprise that while interest rates have been going straight up the last 3 sessions, the stock market at large has been going straight down during that time period. Now, because of the relationship between interest rates and bonds, that's a little bit more direct, right? With stocks, it's a little bit more indirectly related, depending upon the sector. There are some sectors that could benefit from rising rates. There are others that could be at a disadvantage. But when it comes to bonds, it's more universally the case that when interest rates are rising, bond prices are falling. And you will see that that is exactly what's happening here as well. As we look at TLT on the left-hand side in the middle rung, notice that we've fallen sharply here. In just the last week and a half, we've fallen from that moving average to being considerably below it. And you can see that same thing playing out there with foreign bonds. Notice that foreign bonds have been down 1, 2, 3, 4, 5, 6 days in a row. That is fairly rare. And not only that, but high yield bonds also have been struggling, although you will notice a differentiator there. High yield bonds have just a light pink background color, whereas foreign bonds and long-term treasuries have that dark pink background color. In other words, the bearishness in high yield bonds is not as strong as the bearishness in the other two at this particular juncture. One of the reasons behind that is high yield bonds were actually up today. And remember what I've worked with you guys on in the past, this doesn't always have to be the case, but it happens to be so in this era right now, that a lot of the companies that have raised high yield debt, in other words, junk debt, in recent years have been in the energy patch. Probably less so in the last year compared to the 4 years prior to that, because energy prices have nicely rebounded in the past year. But prior to that, they were in the house of pain. Many of them were on the brink of, disaster, perhaps, going down that pathway of bankruptcy. And so they weren't raising high yield debt because they wanted to. They were doing so because they had to. And so there are days like this where we can find that when oil is rallying strongly and oil stocks are rallying strongly, that high yield bonds, because there's a bigger portion of them from a corporate perspective in the energy patch than, let's say, what the percentage of energy companies are in the S&P 500, that they can actually outperform on a relative basis there. We don't want to overdo that concept because, as you can see, high yield bonds have still fallen pretty strongly over the last week and a half. It's just that today they certainly stood out. While these other two bond categories were down significantly, high yield bonds managed to rally a fair bit and actually are the only one of the three that have a yellow moving average tip. In other words, the moving average remains going higher. Because of the sell-off in the other two, notice that the tips of the other two moving averages have now turned to red. With the foreign bonds, that just happened today. So high yield bonds probably would have followed suit had they gone down today. But because they went up, they kind of saved themselves there, and they're giving themselves that fighting chance to get back above that rising moving average here in coming sessions. So let's see how that plays out, but that's my theory as to why high yield bonds seem to outperform today. They were somewhat loosely associated with oil companies themselves, which outperformed today. Also, be aware that the US dollar has been a key talking point in this market recently. That's the chart in the lower left-hand corner here. US dollar was actually down today, but that was after a furious rally. I mean, take a look at this move starting on August 11th and ending yesterday. That was an 11-day move where the US dollar basically went straight up, and you don't see that all that often. But that is the environment that we find ourselves in. Now, many of those days, Treasury yields were also going up. So part of it could be foreign investors, basically selling their foreign currencies like euros and yen and what have you, converting them into US dollars, and then investing in US treasuries, which have a higher yield than a lot of other treasuries or foreign government securities around the world. US dollar can also be a place where it is viewed as a little bit of a safe haven out there in times of chaos. A lot of times people refer to it as the best house in a bad neighborhood. So in other words, it's not that our currency is vastly superior. It's just that it's a little bit better than the alternatives out there. The old saying that you don't have to be faster than a bear, you just have to be faster than the person you're with when you encounter that bear. That's what it kind of reminds me of. So it's not that we've got some sort of a sterling reputation with the US dollar. It's just that it does remain kind of a go-to area in times of chaos because it's relatively better. And so I think you're seeing the benefits of that right there. So US dollar is strongly bullish at this moment in time. It does have price above a rising moving average, but one of the things that I want you to look out for is this would be an interesting point for it to top out at, right? Because it basically stalled exactly where it stalled back here on July 14th. So we'll find out if that's just a coincidence or not, but it could very well be the case that maybe it needs to cool off a little bit. That is an aggressive move from high to low right there. It also happens to remind me that some of you saw me tweeting about this. I know not all of you follow me on Twitter, but some of you do, and you might have seen me tweeting about the stocks on the dividend stair-step chart that were either in the blue undervalued category or the orange overvalued category. And it just so happened to be, and I didn't realize this until I'm giving you this presentation right here on the spot, but those were the 2 days where that reversal took place. If you go back and check my tweets in a chronological order, I believe it was August 11th when I first said that, hey, we actually have more overvalued securities than undervalued securities, and then it was just yesterday that finally crossed over, and it was probably due to a lot of that pressure there. When the US dollar is strong, there can be some reverberations within the marketplace, and a lot of those dividend growth types of companies that I like to focus on do have an impact there as well. While they're not purely foreign securities, many of them have a big chunk, in fact, some of them have a majority of their chunk of revenues coming from overseas markets, so there can be an impact there. But anyway, take a look here at this possible double top setup. Right now we have to assume that it won't hold, right? That's what the posture is telling us. That's what the green line on the market forecast, the moving average is telling us. But there's at least a fighting chance that there could be a bit of a stall out right here because of where it stalled out last time. So let's keep our eye on that potential story developing right there as well. All right, let's go ahead and, and by the way, foreign stocks were up just slightly today. It wasn't a big deal. EFA was up 0.05%. EEM was up 0.53%, so about 0.5% there, a little bit better. And remember, with the US dollar being down today, a rare day that it's down in the last couple of weeks, that makes sense that foreign stocks outperformed US stocks on a day like today. However, the background colors of the charts, which are referring to an intermediate time period, not just one day, are telling you the opposite. So we'll see how that gets resolved moving forward as well. All right, let's go ahead and now take a look at our chart 5C. This is our US sectors 12 grid. And as you can see here, it's also a mixed bag between bullish and bearish charts. However, the one thing I would say is that when we have the pink charts on the board, all of them are that light pink shade, telling us that they're weakly bearish, not strongly bearish, whereas all of the green charts on the board are that darker shade of green, telling us that they are strongly bullish. So I guess there's probably a slight edge to the bulls if you think about it from that perspective. That can change, of course, and it does change. That's the whole point of markets and cycles and everything that we review on a daily basis. But that is a little bit of a change compared to what we saw just a week ago when most of these charts were green across the board. Now you're starting to see a little bit more wear and tear. Some of these charts are starting to relent and go back into their more bearish kind of philosophies. If we take a look at one of the worst offenders here, I would say that communications has nosedived, and I didn't specifically point that out when I was showing you the sector selector there a moment ago, but I'm pretty sure communications was at the bottom. Yeah, there it is, at number 11 again, and they've been at the bottom for 3 out of the last 4 weeks, so they're no stranger to being dead last, and this past week has not done them any favors. Twitter today specifically probably hurt any sort of a rally attempt in that particular area. So for a while it seemed like they wanted to break out. Part of that was Disney was starting to perform a little bit better, some of those media names, but here in the last week it seems like a lot of those social media names like Meta, which we did an Iron Condor on. I'm going to keep my eye on that on the bottom side now. And then also looking at what happened with Twitter today in the social media space. That's not doing any favors for XLC because they're so influential in that area these days. So that's one that's becoming a little bit more concerning on a sector perspective. I'd also throw healthcare in there. And, I didn't realize that the chart looked like this specifically, but I had a feeling it would look pretty bad given what I saw there with you guys earlier in the presentation when we were looking at the heat map. Because remember, I specifically pointed out that healthcare looked pretty ugly today. There were only like 3-4 different companies that even closed in the green, and that's pretty rare because healthcare is a very broad sector, similar to what I was mentioning about technology. But today was a very bad day for healthcare, and as you can see, it is now having an impact on the chart as well, where it was down 1.4% today. That was the second worst performer after real estate, which was down 1.5% today. But as you look at those two charts, notice that healthcare is cutting down below that moving average more aggressively at this point than real estate is. Real estate and utilities both suffered here today as a result of rising interest rates as well. Remember, there is a lot of interest rate sensitivity there. Plus, there's some other real estate news with home building developments and things like that came out. But this has been the 1, 2, 3, 4, 5, 6th straight day to the downside on real estate. Utilities look a little bit better. But even that is its 3rd straight down day. So the rising interest rates not doing any favors for technology, for real estate, and for utilities. Healthcare, I think, is just a separate story altogether. I know some of the foreign healthcare companies like Glaxo and Sanofi especially have had some problems there. Might end up finding themselves in a courtroom, but that might have a little bit of an impact on the sentiment within that group right now as well. In terms of the areas that did a little bit better here today, I already mentioned that energy was the big winner today. It was up 3.61% today. In fact, it was such an aggressive move that you actually got an overbought cluster signal. How about that? At a time when we've had 3 straight down days for the market, you actually have an entire sector that is overbought right now, according to the market forecast, and that is energy. So today should be an interesting email that you guys received from me. I haven't checked yet, but when I put those clusters signals at the bottom of the emails that you guys get, there's probably going to be a nice healthy divergence in there where you get a lot of energy companies with overbought clusters, and then you get a lot of other companies with oversold clusters. And that's not always the case. If you study those emails close enough, you'll notice that there's plenty of days where you have 0 stocks on, let's say, the overbought clusters, but you have tons on the oversold, or vice versa. So today is going to be kind of an interesting day where you've got some really overbought companies and you've got some really oversold companies. So it's keeping us on our toes for sure. You'll also notice that energy is still quite a long ways off of its highs that it set back here on June 8th. And so we'll see if that ends up becoming a problem for them, as there's a little bit of overhead resistance there, or if this current momentum can continue to push them higher. So without a doubt, energy was the big winner here today. Although they were hardly alone, you did have materials up nearly 1% today, industrials were up 0.19%, and discretionary was up 0.28%. So it wasn't a complete wipeout day, but it was one that you had energy really rallying strongly, and then you just had a few other areas with some green here and there, but it wasn't like earth-shattering type of stuff. So quiet day compared to the last 2 days, and we'll see what the next few days bring as we get a little bit closer to Jackson Hole. All right, let's talk about our trade application example for the day now. And for that, I'm going to start with chart 2A. Now, earlier in my dividend growth investing class that I taught today, or actually it was yesterday afternoon. I take that back. Yesterday afternoon in my Options for Long-Term Investors class, I was mentioning how I've been kind of getting itchy to do some sold put trades again in the market outlook videos, but I tried to do those when the market is down 1%, and it just so happens that the market was down more than 1% the last 2 days, but those are the days that David was scheduled to do the video, so I didn't get the opportunity to do that. So it was a little frustrating today. I'm like, okay, maybe today will be the day I can do some sold puts again, but it just wasn't in the cards, as today was another modest day. So that was my original hope. Instead, I opted to go with a bearish trade instead. And remember, our bearish trades have all of a sudden been working really nicely for us. Some of you might have thought it was odd when I was putting those bearish trades on, 3-4 weeks ago or whenever it was, with like Amazon and Charter Communications and what was that other one? Match Group, that dating website. I was doing those when the market was very bullish, and that might have been a bit peculiar to some of you. After the last 3 days, you now know why I do that. It's you've got to have something on the other side of your portfolio to balance things out and work for your benefit in the eventual corrections or reversions to the mean that will take place. So today was one of those days where I was hoping we'd have another big washout so I could do something bullish, like selling a put, to go the opposite direction, but it just wasn't in the cards. So today, what I opted to do was another bearish trade. This one does not involve the options market. It is a purely stock-based trade, so you do need a margin account in order to short sell stocks. So all of you might not be able to do that, but you'd have to check with your broker if that was of importance to you. But let's talk it through. So the ticker symbol is SYY. Now this is Cisco, but before you get too into the analysis, let me just specifically state this is not the tech version of Cisco. Speaking of sold puts, we actually have some sold puts on Cisco, the tech company, in my class for premium students on Monday afternoon. So we were happy to see that it responded very nicely to its earnings last week. This is the other Cisco. This is Cisco, the food company, ticker symbol SYY. And this first chart here is not the emphasis of the analysis here tonight, but I wanted to simply point out that on this long-term chart that I use for dividend growth investing, Cisco would be considered overvalued here. Now keep in mind, valuation is not an excuse to take a trade, because a stock that is overvalued can remain overvalued for weeks, months, maybe even years. But I'm just merely pointing that out as maybe an extra kind of honorable mention reason why I might be a little bit more interested in taking a bearish trade on something that would also be perceived to be overvalued. Here's that orange zone that I was referencing before, effectively stating that its current dividend yield of 2.3% is viewed very poorly in relation to its dividend yield throughout history. And so when it's up in this orange zone, you can kind of think of that as overvalued. When it's down here in this blue zone, you can think of that as undervalued. So up at these levels, we still look at Cisco as being a bit overvalued from a long-term perspective. But let's kind of zoom in now to a swing trading chart to look at what's happening just in the last few months, where we might get a little bit more insight. And again, ticker symbol SYY. Oh, the other thing I was going to point out real quick, again, this is kind of honorable mention, but I'll point it out just because it's interesting. On the stock selector tool that we use for my trend trading class on Mondays, Cisco, as you can see here, is ranked 504th out of 1,000 stocks that we track using the WAR score, which is just an acronym that stands for Weighted Aggregate Returns, and it's taking return performance information from a variety of time periods. It's aggregating them together, but it's weighting them more heavily with the more recent time periods. And as you can see, it's ranked 504th out of 1,000. That's not particularly good. Now, it's not particularly bad either, but, you know, given what we saw in that long-term chart a moment ago where it was way up in that orange zone, you might have thought that Cisco was one of the outperforming stocks right now. But this is basically telling us that, hey, it's starting to slip a little bit. And this is the stock rank history tab. So remember, those of you that are premium members have access to this tool. If you're not a premium member of Market Scholars, unfortunately you don't, but hopefully you become one at some point. Remember, we should be having our Black Friday sale coming up as we typically do later on in November. So store that away in the back of your mind as you're thinking about, you know, saving up some shekels there and expanding your investor education. But for those of you that are premium members, if you click on that stock rank history tab, it's going to not only show you what the current rank is, like this default tab will, but it's going to show you what the previous week's worth of rankings were as well. So that way you can kind of get a sense of how relative strength and relative weakness is entering into any one given stock. So you'll notice here that Cisco, for a long while, was actually considered one of the top performing stocks. It looks like its best ranking that I see here was it was ranked as high as 41st out of 1,000 at the end of June. But it was right around that time, remember, that the rest of the stock market was really going to start bouncing aggressively, and some of those boring consumer staples that were outperforming at that moment are going to take a back seat. So you'll notice that those rankings slowly started to slip from 41 down to 49, down to 73. Then you kind of had a little bit of improvement right there, but then it went down again to 114, and then you had a color shift from green to yellow, and that's basically moving from what we would consider positive to neutral from a purely price-related perspective. And that was a pretty steep drop-off there from 114 to 570. That probably happened as a result of an earnings announcement. Usually you're not going to see a company like Cisco have that big of a drop-off in the rankings. But anyway, whatever caused that, whether it was earnings or something else, that was a pretty sharp reaction to it. That fell all the way down to 570. It did have one time last week where it was even worse. So maybe a little bit of a rebound here week over week. But the point being, you've seen some wear and tear on its relative strength here recently. And that might help us feel a little bit more comfortable with a bearish trade here in this case as well. So let's now go back on over here to the Thinkorswim charts on chart 3A here, and I'll show you that yesterday we had a sizable enough sell-off on Cisco's shares where we cut below that moving average, where the background color went from blue to light pink, telling us that this blue line is now considered bearish. That is the near-term line, which is what we use for swing trading purposes. But not only that, the traditionally default intermediate green line is also considered bearish at this moment in time at 58 and falling. So that would be considered weakly bearish in that case. Not only that, but you will notice that you have a red moving average right now, telling us that price is below a falling moving average. And you even have a little bit of a divergence signal. Notice that we had a peak here on the blue line back here on August 16th, and then you had a slightly lower high on the blue line on August 19th. And the two candles associated with those two levels are this one right here and this one right here. So price went slightly up at a time when there was a slight deterioration in the underlying indicator. Then that's not something that is, a guarantee or anything like that, but it's just trying to help you evaluate the situation a little bit more thoroughly beyond what somebody else might be doing out there. So those were the main reasons I thought, hey, let's take another bearish trade here. You can see that I did put the stop loss above this high over here by a couple of pennies. So if it does break to new highs, multi-month highs, we would be stopped out. But on a one-for-one reward-risk relationship, the price target I'd be shooting for is down here at 81.76, and you can't really see it here because this tag is kind of blocking it, but let me see if I can extend this. There we go. Just wanted to point out that on this day here on August 10th, it was trading as low as 81.36. So it wouldn't require a multi-month breakdown to get to our price target. It just would require us to get back to where we were trading at the lows of August 10th. Now, there is one fly in the ointment, is that is that this is still a market-beating security. You can see the S&P 500's dotted line is down here, and Cisco's price candles are above it. So, not a perfect setup by any means, but one that I guess is reasonable enough to take for this paper money purposes here today. Okay, so that's what I had for you. I hope you enjoyed the analysis and the presentation. If you did, I have one simple request for you. Just simply click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do this on Thursday afternoon, I'll plan on doing another full-length video, including a trade application example. On the other hand, if you prefer the shorter videos and you don't want to click like, I'm more than happy to do just a 15-minute video for you on Thursday as well. So we'll leave that up to you, but I appreciate you checking this out as always, and I wish you all the best of success with your trades and your investments. Goodbye for now.